Hi everyone, and thank you for tuning into my channel where I talk about stocks, the stock market, and investing. I post videos daily, so if this sounds like something you want to get more of, subscribe down below. In today's video, I'm going to answer the question if the trade desk stock is a buy. I'm going to use my simplified 6-step framework for analysis, and before the end of the video, you'll have your answer. So let's get right into it. The first step in my framework considers the customer value, and the trade desk offers automated buying of digital advertising that's enhanced by its data. So far from 2014 to 2021, revenue has exploded from 45 million to 1.2 billion. From this evidence of its revenue explosion, you can tell that its customers are getting good value. They perceive very good value from dealing with the trade desk. So excellent customer value here. The next step in my framework considers unit economics. And for the trade desk, their investments in technology are scaled across its growing client and spending base. So as that spending grows and clients grow, their investments in technology are spread across a wider base, which increases profitability as they see growth. So solid evidence of economies in scale. They have a rare combination of explosive revenue growth like we saw in the previous slide and profitability on the bottom line. Their operating income rose from 38 million in 2015 to 125 million in 2021. So they're growing quickly, but they're still profitable on the bottom line. That's really good to see from an investor's perspective. The next step in my framework is the total addressable market, especially important for companies that are growing as rapidly as the trade desk is. You want to see a really large market opportunity so that way it can continue growing without hitting a ceiling. And according to Group M, marketers spent $763 billion on advertising in 2021. That was on globally, but that excluded political advertising. If you include political advertising, that figure is going to be even larger. The next step in my framework considers competition. And in this industry, competition appears to be based on capabilities, the data, and the conflicts of interest. What I mean by conflicts of interest is that, for instance, Alphabet sells advertising across its, it has YouTube and Google and all the Google properties. But Alphabet has a conflict of interest there because Alphabet also owns the Google properties. So it's interested in selling advertising, keeping it inside of Google, keeping it in YouTube, keeping it in Google search. It's not interested in selling advertising outside of the Google properties. That said, there's little evidence of price competition between the various advertising platforms out there. Another form of competition facing the trade desk is legacy advertising categories like print newspapers, billboards, and cable TV. Over the years, more spending has been moving away from those channels into digital advertising because of its higher return on investments and greater measurability. Still, these legacy providers can prove formidable and potentially could stop that outflow from their services to the digital services. One of the more important steps in my framework is valuation, and when you measure the trade desk in terms of its price to free cash flow, it is relatively inexpensive. You have had few opportunities to buy the trade desk at a price to free cash flow of 64 in its recent 5-year history, going all the way back to 2018. You may have had one opportunity here and another opportunity earlier this year to get it at a lower valuation, but other than that, few opportunities. So it's arguably at its cheapest price to free cash flow it has been in the last 5 years. So relatively inexpensive, although a price to free cash flow of 64 on an absolute basis cannot be considered cheap. The final step in my framework considers risks, and one of the major risks the trade desk is facing right now are macroeconomic headwinds that's reducing advertiser demand. We have widespread supply chain shortages, and if you're a company that can hardly keep up with organic demand, you have little reason to advertise, and so that's reducing advertiser budgets. Another factor reducing advertiser budgets is the Russian invasion of Ukraine that's disrupting the European economy. And when advertisers feel uncertain about their future prospects, they reduce advertising and they wait and see how this scenario plays out before they spend money trying to spur consumer demand. The second risk I note here is a slower transition of legacy advertising budgets. Consumers have already begun spending less time reading print newspapers, watching television through cable and satellite connections, and they've switched over to streaming and connected TV. However, advertising budgets have been slower to shift over to smart TV, connected TV, and print and digital magazines and all of those other things. So consumer attention has shifted faster than budgets have shifted, and if there's that slower transition of advertising budgets over to those digital channels, that could prove to be a headwind for the trade desk, which generates revenue by encouraging sales of digital advertising. It sells digital advertising and earns a commission for facilitating those transactions. Let's look at the grading for each of those aspects. For customer value, I gave the trade desk an A. Explosive revenue growth is evidence that consumers, its clients, are perceiving high customer value in dealing with them. Unit economics, I give them an A here. They invest in the technology, and if they can achieve revenue growth, then that technology is scaled across a wider customer base, which shows up in higher operating income, higher operating leverage. So I gave them an A there. Total addressable market, I gave them an A plus. Market opportunity close to $800 billion is excellent. Competition, I also gave them an A here. There's little evidence of competitors fighting over price, lowering price, trying to reach the lowest price in the market. So that's good news for investors. Risks, I gave them a B plus, even though the risks are meaningful in the near term and advertiser budgets are getting lowered and the risks of recession are elevated, which could decrease budgets even further. Those risks, however, are more near term and short term in nature, and so for that reason they get a B plus instead of a lower score here. Valuation, I gave them a B plus here because relatively speaking they were inexpensive. However, on absolute terms, the price to free cash flow in the 60s, you can't say it's cheap. So relatively cheap. On absolute terms, you can't say it's cheap, so I gave them a B plus there. Okay, so now that we've considered all of the frameworks, each step in the framework, and given it a grade, let's answer if the trade desk stock is a buy. The trade desk stock is a buy. The massive market opportunity, evidence of excellent customer value, together with the relatively inexpensive valuation, make the trade desk stock a buy. Okay, so thank you for tuning in. Let me know what you think about the trade desk stock below, and I'll see you next time for the next installment of Is This Stock a Buy? Thank you for watching.
I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular Stock Advisor. Stock Advisor has beat the market by more than 250%. Go to fool.com/Parkev to get your 10 stock picks now.